Hi, I'm Adrian Helfert. I'm Director of Multi-Asset Portfolios here at Westwood. Just setting the stage for where we are, the 10-year U.S. nominal Treasury has fallen from about 2.7% at the beginning of the year to 2% today. And in May, continuing into June, it's increased its rate of decline, falling from around 2.5% down to the 2%. At the same time, this is met with risk-on behavior, with the S&P 500 as our metric up nearly 20% on the year. The 10-year U.S. nominal Treasury is usually thought of as indicative of prospective growth rates, yet at the same time the S&P 500 up 20%, there's a disconnect. During this period, prospective growth rates have not increased, prospective earnings of companies have not increased, save certain companies and sectors, yet at the same time we've seen asset prices go reasonably well. As I said, with the S&P up significantly. We saw an indication last week of what's helping drive this. The Federal Open Market Committee, the Fed's Monetary Policy Board, came out and said that they're likely going to drop rates in short order. They gave their reasons of lack of inflation, lack of growth, and significant risk overhanging the economy. This is the Fed effectively giving the market a put, an option like put that helps support asset prices when they go down. This week, we'll see an indication of that significant risk overhanging the economy, which is surely in part the trade war. The G20 is going to meet, with China and the U.S. spending extended time talking about where they might go with respect to trade war negotiations. While we are for sure going to see a handshake and I'm sure some tweets that will come out, we don't expect a near-term solution. Hopefully we see progress toward this, but the continuation of the year will be a continuation of discussions. Our base case is the Fed will cut 25 basis points twice this year as they help support that flagging inflation, flagging growth, and we see a continuation of trade war concerns at least till the end of the year. At the same time, equity valuations can be supported by the FOMC doing exactly that, though they may not be as elevated and certainly appreciate another 20% continuing into the year. Also looking at interest rates across the curve, we expect they'll remain anchored at the very least, and credit may be a little less attractive as spreads or the insurance rates you receive against defaulting companies are not as attractive as they have been in the past. Thanks for listening and enjoy investing.